Happy Friday, Eric Bible with the Bible team at Neil Home Loans. It's a wonderful Friday, an interesting week. All in mortgage interest rates have pulled back from last week's high of 6.9 to this morning 6.63. Now they are feeling some pressure. So these numbers could change throughout the day, and it's really on the back of some conflicting information data around jobs, which I'll get to in a second. But this week provided a ton of insight as to what we can expect this year, what the Fed's doing, and ultimately where we see home prices and interest rates going. The facts still remain. Activity is undoubtedly picking up in multiple markets throughout the United States. Buyers are back in full force. We are seeing some new listings, albeit we still need inventory. But with the fact that this excitement is here, buyers are re-engaging, multiple offers, over list, removal of contingencies are reigniting. Multiple counters, multiple offers, you name it. So we'll get to that here in a second. But let's really unpack what transpired this week, what we're seeing, what we're expecting going forward. So as we know, and as I've been sharing for the last few weeks, first Fed meeting of 2024 took place on Wednesday. As expected, the Fed did nothing to interest rates, left them unchanged. That said, though, there was some additional insight that really provided the needed confidence to the market that we're at the end of this hiking cycle. For the first time, the Fed came out and said rate hikes are out of the equation. Additionally, they indicated that rate cuts are forthcoming later this year. Now, we don't know when, we don't know the frequency, we don't know the timeline, and Jerome Powell was very tight-lipped around when we can expect rate cuts, but it does appear with factual data now to say that we're at the end of this cycle. Markets truly needed this, and in turn, we saw significant rally Wednesday and Thursday, which ultimately provided the credence that inflation is behind us. We need to focus on the labor market, but it does appear that the Fed is done with the cycle. So definitely something we will continue to monitor. Additionally, Jerome Powell said it's unlikely we'll see rate cuts in March, but the market is still banking on that, and it's really coming on the back of some reemergence of banking instability. In concern, as we saw last year, fallout from Silicon Valley Bank, First Republic Bank, Signature Bank. There's some grumblings in that sector, and Jerome Powell alluded to that. So definitely more to come on that front, where again, he said no cuts in March, or I should say cuts unlikely in March. Market is still kind of calling their bluff. So definitely something we're watching, something that we need to provide some more info as it's received. That said, jobs, and it's really becoming a tale of two cities. As we know, the Fed's mandate, inflation in line, price stability, inflation at 2%, and maximum labor. Now, this week, and as I've been saying for the last few weeks, labor has been an interesting roller coaster. We've seen conflicting reports from a rise in initial claims, individuals filing for unemployment for the first time, followed by continuing claims, those unable to get back into the labor force. Additionally, we've seen headlines from UPS to Microsoft and you name it in between. Layoffs are forthcoming. This week, we saw effectively 3 reports from ADP private payrolls, initial claims, continuing claims, painting a picture of the weakening labor market. This morning, on the other hand, we saw yet again a blowout jobs report. Unemployment fell or remained at 3.7, past its expectations of 3.8. And we saw 173,000 more jobs created than expected, landing at 355. So it really paints an unknown picture, if you want to call it, for lack of better words, is that we have one sector, one side of the table saying, hey, labor's weak, and the other side, no, labor's strong. So market is definitely unpacking this. We are seeing some volatility this morning, but there's some underlying components, and I believe as that report gets fully understood and reviewed, we could see this pendulum shift in the other way. That said, this is something that will continue to influence Fed behavior. So something we are watching very closely. As always, more to come on this front. And then lastly, home appreciation. So as we know, the media, multiple media outlets, sources, you name it, had advocated for an all-out housing crash last year. We saw the exact opposite. Case-Shiller, revered as the gold standard for home appreciation, released their November appreciation numbers. And by surprise, actually by no surprise, I should say, we hit all-time highs. Rounding out the year, yes, we're still waiting for December to come in. It looks like we'll see between 6 and 7% appreciation in 2023. And mind you, this is on the back of multi-decade high interest rates. So the narrative around housing is going to crash, that has been flipped on its head. And we're already seeing the activities of buyers and sellers today with improved interest rates. Homes are selling for higher than list price, multiple offers, limited inventory, buyers having to do things not done since 2021. The message needs to continue to be delivered that if you're in the market, act now. This is your time. Do not sit on the sidelines. Your future self will be grateful for if you wait today and you are already tight on approval, there is a good possibility you may never have the opportunity to enter the housing market. If you need help delivering this message, we're here to support you. With that, as always, make today, Friday, a great Friday. And more importantly, make it a great weekend. Talk to you soon.